Hey everybody, Tim Harrison from the HLC team at Cornerstone Home Lending, as well as Straight Up Mortgage Talk, my educational series. So today I want to talk about the Federal Reserve and when they raise interest rates and lower interest rates and what they're trying to do with that. And how is it related to mortgage-backed securities or mortgage rates? So when the Federal Reserve is raising rates, 0.5% or 1/4%, it is usually to slow down an economy that's going too fast, and they're concerned about inflation. Well, why do they want to control inflation? Well, because they don't want the cost of goods and services to go up faster than our wages and we can afford less. A lot of us are feeling that right now. When there's a recession or the economy starts going too slow, what they want to do is lower interest rates so people can borrow at a cheaper rate and they can actually go out there and spend more and fuel our economy to get it moving again. So again, they're going to change these interest rates. The reason why they're not directly related to mortgage rates is that the Federal Reserve changes what's called the federal funds rate. That federal funds rate is what banks borrow from the Federal Reserve on an overnight basis to shore up cash reserves. They're required to have a certain amount of cash reserves as compared to what they have loaned out. So it's overnight basis. It's a very, very short term, whereas mortgages are long term, 30 years and max. So what happens is, let's say, for example, now where there's inflation and the Federal Reserve is raising interest rates to slow down the economy so that it doesn't get so crazy that we have lots of inflation and goods and services keep going up. If the long-term market, meaning bond investors who buy mortgages over a 30-year period of time, thinking that the Federal Reserve will be successful by raising those short-term interest rates, that they'll actually keep a lid on inflation, then those mortgage bond investors who buy mortgages are going to be feeling much more comfortable to take the rate that's going on right now on a 30-year fixed or even lower, because they might think, hey, if the Federal Reserve could actually slow down the economy too much and put us into a recession or get rid of inflation, now I'm not going to get 5% in 6 months. I might get 4.5%. I really want to buy these mortgages now. That brings more buyers, that brings the price of that long-term mortgage down. Now again, sometimes there's a trend. They think there's going to continue to be inflation and interest rates are just going to go up for a period of time until the economy turns and slows down. But again, Federal Reserve is a very short-term overnight basis that they take, and then mortgage-backed securities is a totally different type of investment because they're looking at what they're going to get for the next 30 years. Hope that explains, but again, what you won't see usually is a direct correlation to what the Federal Reserve moves on a short-term basis versus a 30-year mortgage for that reason. Tim Harrison, HLC team, Cornerstone Home Lending, as well as Straight Up Mortgage Talk, my educational series.